With all the distractions of the election, we need to bring up a chart to remind ourselves what we do, election to election, worry to worry, and the rest of it as well. Bring up this chart, if you would, right now, Riley. The idea of the stock market, yes, the depression on a log basis, really painful over on the left side of the chart, and there's a few more bumps and malaise along the way and all. But you know what? The politics is one great distraction to one great bull market, isn't it? It's, you know, at the end of the day, it's from the lower left to the upper right, isn't it?
Well, it is. Right now, it's true that the global economy is slowing. Earnings growth is decelerating, but we are indeed reminding clients to stay invested because we see no recession in sight. And decelerating earnings are different than declining earnings. And that's really the important message.
This is really, really important. Kathy Fisher going to calculus on election day is really important. So earnings are up a tax-affected 20%, double digit. And you're saying they're not going to go down. They're just going to come down to what? Single-digit level?
That's what the market is trying to figure out. The market's trying to figure out what will the growth of earnings be in 2019 and 20, and therefore what multiple should those earnings have as rates are rising as well. That's why we're having this recalibration right now of what stock valuation should be. The midterms are interesting, but the bigger questions are what happens to trade and what happens to interest rates.
Is cash interesting?
Cash is better than it was, but for long-term investors, cash is never optimal. Even those in bonds who have a well-managed bond portfolio will see higher returns in bonds over a multi-year period as the bonds rolled into higher-yielding investments.